Do you know the one thing that can help you avoid financial struggles down the road? Mastering the basics of personal finance early. We all dream of financial freedom, but getting there requires understanding and managing money from the get-go. In this video, we will share the 5 most important personal finance basics that everyone should learn early. Whether you're just starting your financial journey or looking to get back on track, understanding these 5 personal finance basics will set you up for success in 2026 and beyond. Ready to learn how to take control of your money? Let's dive right in. 1. Budgeting and tracking expenses. Mastering your budget is the first and most crucial step to achieving financial health. Without it, you're essentially flying blind when it comes to your money. The key here is understanding your cash flow. That's the money you earn versus the money you spend. This helps you make sure you're living within your means and, importantly, saving for the future. A popular method for budgeting is the 50/30/20 rule. 50% of your income goes to needs like rent and groceries. 30% goes to wants like entertainment or dining out. And 20% should be saved or used for paying off any debt. Tracking your expenses isn't just about knowing where your money goes. It's about actively being in control of your financial life. If you use apps like Nab, You Need a Budget, or Simplify by Quicken, you can make the whole process seamless. These tools help you categorize your expenses, set up spending limits, and remind you when you're about to overspend. Over time, you'll notice patterns and can tweak your budget to save more or allocate money towards things that matter most. The earlier you start budgeting, the easier it becomes to build strong financial habits. You'll be in a better position to handle unexpected expenses and save consistently. Plus, budgeting helps prevent impulse buying, keeping your money where it needs to be, working for your future. This simple practice can make the difference between feeling stressed about your finances or being in complete control. 2. Building an emergency fund. Life happens, and when it does, having an emergency fund is your cushion to prevent unexpected expenses from spiraling into massive debt. Picture this: your car breaks down or you lose your job. Without a solid safety net, these situations could push you into high-interest credit card debt. Having an emergency fund gives you peace of mind, knowing you're prepared for life's unexpected curveballs. Aim to save 3 to 6 months' worth of living expenses in a high-yield savings account, HYSA, for maximum growth. The key here is liquidity. Your emergency fund needs to be accessible when you need it most. If you're just getting started, begin by saving a small amount every month and gradually build it up over time. The earlier you start, the quicker you'll get to a point where you feel truly financially secure. It's the foundation for any long-term financial strategy. An emergency fund isn't just about covering your basic expenses. It also acts as a buffer, allowing you to make important life decisions without the added pressure of financial stress. Whether it's moving to a new city, taking a career risk, or investing in something that requires time and money, an emergency fund empowers you to take those steps confidently. Having this cushion means you're less likely to rely on credit cards or loans when things go wrong. The peace of mind it provides is invaluable. 3. Managing and avoiding high-interest debt. Debt can be a wealth killer if you're not careful, especially when it comes to high-interest debt, such as credit card balances. While certain forms of debt, like a mortgage or student loans, can help you build long-term wealth and invest in your future, high-interest debt will only drain your resources and make it harder to reach your financial goals. The key is understanding the difference between good and bad debt and tackling high-interest debt as soon as possible. When it comes to paying off debt, there are 2 popular strategies: the debt snowball and the debt avalanche. The debt snowball method involves paying off your smallest balances first. This approach can be motivating because you'll see your debts disappearing quickly, which helps you stay focused on your goal. On the other hand, the debt avalanche method targets the highest interest rates first. This strategy saves you the most money in the long run, as it focuses on paying down the most expensive debt faster. Whichever strategy you choose, the key is consistency and making high-interest debt a top priority in your financial plan. The sooner you eliminate this debt, the more money you'll have to invest and save. It's also crucial to understand that not all debt is bad. Some types of debt, like student loans and mortgages, are considered good debt because they help you build equity, invest in education, and work toward financial independence. However, consumer debt, such as credit card balances and payday loans, tends to carry high interest rates and can quickly spiral out of control. By focusing on reducing these high-interest debts, you free up more money for other financial goals, like building an emergency fund, saving for retirement, or buying a house. 4. Understanding the time value of money, compounding. Did you know that time is one of the most powerful tools when it comes to growing wealth? The earlier you start investing, the more your money works for you. This is due to the concept of compound interest, the idea that the money you earn from investments starts earning its own money over time. Even a small amount invested early can turn into a large sum in the future, thanks to compounding. For example, let's say you invest $1,000 per month. While it may seem like a small amount, over time, compound interest will allow it to grow much faster than if you wait to start investing. This is why it's crucial to start as soon as possible. Don't wait for the perfect time to invest. A simple and effective way to get started is by using employer-sponsored 401k plans, especially if they offer a match. That's free money that you can add to your retirement fund. Take advantage of compound interest by making small, consistent contributions over time. It's one of the most powerful wealth-building strategies out there. The beauty of compound interest is that it's often referred to as the eighth wonder of the world. By reinvesting your earnings, you allow your wealth to grow exponentially. This is why it's important to start contributing to retirement accounts or investment funds as soon as possible. Over time, even modest contributions can result in a large, healthy nest egg, especially if you start early and remain consistent with your contributions. 5. Protecting your assets with insurance. Financial planning isn't just about growing your wealth. It's equally about protecting it from unexpected events that could throw your financial goals off track. Health issues, accidents, or even natural disasters can quickly wipe out your savings if you don't have the right insurance coverage. Insurance serves as a vital safety net to protect your assets, ensuring that if the worst happens, you're not left with crippling financial consequences. At a minimum, everyone should consider having health, auto, renters or homeowners, and disability insurance. Health insurance ensures you're covered in case of medical emergencies, while auto insurance protects you from the financial consequences of car accidents. Renters or homeowners insurance protects your home and belongings from theft or damage, and disability insurance ensures you continue to receive income if an injury or illness prevents you from working. It's crucial to regularly review your insurance policies to make sure your coverage is up to date and reflects your current life stage. As you go through life changes, such as getting married, having children, or buying a home, your insurance needs will evolve. Ensure your coverage grows along with you. Insurance doesn't just shield you from financial disaster, it also helps protect your way of life. Disability insurance, for example, allows you to maintain your income if you are unable to work, preventing financial hardship. Home and auto insurance provide coverage against unplanned events like accidents or damage. Regularly checking and updating your coverage can give you peace of mind, knowing that you're protected from life's unpredictable twists. So there you have it, the top 5 personal finance basics that everyone should learn early. By mastering these pillars, you're setting yourself up for long-term financial success. Remember, financial freedom isn't about how much you earn. It's about how well you manage what you have. Take the first step today. Start budgeting, building your emergency fund, and investing in your future. If you found this video helpful, don't forget to like, share, and subscribe for more personal finance tips. Thanks for watching, and we'll see you in the next one.